Thank you all very much for joining us this morning. My name is Steve McMenamin. I'd like to welcome you to today's event, which is part of the continuing series of the Greenwich Roundtable. Our topic this morning, technology. Thanks, Peter. Technology 3.0, bubble or boom, is a continuation of the session we first held in the salad days of 1996. And in those days we were talking about clicks and eyeballs and domain names, and profits were passé and bricks and mortars were a thing of the past. Nowadays we're hearing some startling reports of outsized profits and dominant franchises. Is this another gold rush? Our speakers are the best athletes in this new frontier, and I'll briefly introduce them after I say this, if I can't say it. The speakers have views of their own and don't necessarily represent the views of the roundtable. Sitting next to Peter, Brad Burnham is a managing partner at Union Square Ventures, a venture capital firm based in New York, with $1 billion invested across 6 funds. Brad and his co-founder, Fred Wilson, operate a collegial partnership to invest in companies with the potential to fundamentally transform important markets. Brad started working in information technology with AT&T in 1979. He spun Echologic out of Bell Laboratories in 1989 and joined AT&T Ventures in 1993. Brad co-founded Takoda in 2001 before joining Fred to create Union Square Ventures in 2003. I'm introducing in alphabetical order. Bill Martin is the Chief Investment Officer of Raging Capital Management, an equity long-short hedge fund based in Princeton that focuses on financial services and information technology companies. As a private investment partnership, Bill has an impressive track record. As an entrepreneur, Bill co-founded a number of financial information companies, including Raging Bull and InsiderScore.com. Sitting next to Bill, Devin Parekh is a managing director of Insight Venture Partners, a venture capital firm based in New York with over $8 billion invested. Devin co-manages e-commerce and all software businesses for that firm. Mr. Parekh is a global investor, actively working with portfolio companies in China, Latin America, Europe, and Russia. Devin is director of several tech companies and represents the firm's interests in Alibaba and Twitter, to name a few. Before that, he was a principal at Berenson Morella in New York, a merchant banking firm, as well as the Blackstone Group's M&A and merchant banking group. In 2010, Devin was part of a U.S. delegation that visited Russia to explore investment and technology collaborations. He's a member of the Technical Advisory Council of the Federal Communications Commission. In 2014, President Obama nominated Devin to be on the board of the Overseas Private Investment Corporation. And the moderator of the Greenwich Roundtable today is Peter Lawrence. Peter is a founding partner of Flag Capital, the legendary venture capital fund of funds based in Stanford.
Legendary and collegial.
With over 30 years investing in venture and private equity, Peter is our intellectual anchor to windward in the sea of hedge funds. Peter's a trustee of the Greenwich Roundtable, serving on our programming and executive committees. Please welcome Peter today as he sets the table.
Thank you, Steve. Good morning, ladies and gentlemen, and thank you, gentlemen. We should have a great morning. So let's set the stage a little bit for today's conversation. We have to look back in time a little bit. Information technology-driven business model innovation set off on a quiet tear even before the Great Recession. The gentleman to my left were clear-eyed enough, despite the memories of the tech bubble, to recognize the maturation of the internet platform and envision software-driven applications that capitalize on the efficiencies in those networks. So whether the rest of us saw that or not, and particularly at that time, here we are today, with all sorts of markets having been created, old line industries having been dramatically disrupted, and late-stage private technology company valuations at heights we could never have imagined before. So now what? Bubble or boom? Do we run for the hills or do we dive in? Venture participants don't agree. Todd Degris of Spark Capital, at one time the largest owner of Twitter, says we're definitely in a bubble. This one's not going to be as bad as 2000, but when you wake up in a room full of unicorns, you're dreaming, and the dream can't last forever. However, Mark Andreessen of Andreessen Horowitz sees it differently. He says, in 2000, there were 50 million internet users and the number of smartphones were 0. Today, we have 3 billion internet users and 2 billion smartphones. We're in the development phase of the adoption curve when technology gets adopted by everyone and the real money gets made. So, boom or bubble? Do the mobile internet business models justify their lofty valuations? They do seem to be disrupting every industry, but are they truly defensible? Or can the new market leaders, the Facebooks, the Googles, Amazons, Airbnbs, Ubers, and others be dethroned? If not, does it mean that we've reached the end of this mobile internet innovation cycle? And then, where's the value in tech investing today? Those are the questions that we'd like to start to address, and I'm going to start with Brad, who will set the table for us. Hope that's a good intro. We'll see.
Well, it's actually a very challenging intro because it's a very difficult and complex subject. And so I would try and sort of split the conversation, the boom or bubble conversation, and sort of go halfway between Todd Degres and Mark Andreessen, and say that if you look at it in terms of the valuations of these private companies today, I think those valuations are not defensible. They are too high. If you look at it in terms of the disruption that's going to be enabled as a result of the penetration of these smartphones and the amount of use that they get, the social transformation is absolutely real. It will continue, and so what I'll try and do is describe a little bit about how we're thinking about the market, and sort of split that baby in the middle by saying that the transformation is real. The economics don't justify the valuations. So you have to then go a layer deeper and say, where should you be investing in that situation? So to provide a little bit more background on who we are and what we've done in the past, Union Square Ventures was founded in 2003, and we really kind of rode what people came to call the Web 2.0 wave. We were early investors in Twitter, Tumblr, Foursquare, Etsy, Indeed, Lending Club, companies that were essentially not so much core technology companies as companies that exploited that technology to change some business process or some service, or a lot of consumer-facing web services. I once was able to reduce our investment thesis to a tweet, which had to be 140 characters, and I think it went something like, we invest in large networks of engaged users that were differentiated by user experience and defensible through network effects.
That was 2 tweets.
You sure? They accepted it as 1 tweet, but anyway. And so the basic bet was that when you get a large group of people together on a network, that they would create value in that network, and that would become defensible because as more people joined the network would become more valuable. And that worked really well with companies like Twitter and Tumblr. And so, that has been our bread and butter for the last, really for the 10 years that we've been in existence. But we're now looking at a situation where if you have a consumer-facing web service that has momentum, that's growing, that is adding users month over month, regardless of whether or not it has any prospect of a business model, the entry valuations start at sort of $100 million. And we're an early stage venture capital investor with a $175 million fund, and a $100 million entry valuation just makes no sense to us. And so it's gotten to a point where there's so much interest in these companies because there's the perception that more and more of the global economy is going to find its way into these networks, and so people are just assuming that the networks are going to become, extremely valuable. And so we've actually started shying away from those deals, and we've started looking further afield. We started looking for network effect businesses in more obscure markets. So we're an investor in a market that is obscure for two reasons. One, it's in Kansas City, and the other is that it's essentially a receivables marketplace between large suppliers and large retail outlets that allows them to essentially find a price for discounting receivables. And it has exactly the same characteristics as Twitter in that the more people in the network, the more valuable the network, but it's in a market that isn't as overheated. So we're looking for businesses in these more obscure geographies and more obscure market sectors. The second thing that we're doing is we're trying to identify the next thing. You know, what would essentially undo network effects? So what would, you know, right now what we see happening is that at the same time that consumers are actually becoming sated, you know, most consumers now have 30, 40, 50 apps on their phone. In 2003, when we started, in 2007, when we made the first investment in Twitter, you know, consumers, you know, maybe had seen a smartphone for a year, maybe had one or two apps on it, maybe used Facebook, but they hadn't found all the services that they want. So, you know, there was a sort of an open field. At the same time, the companies that were coming into that market weren't competing with, you know, 50 other apps. So now we're in a situation where consumers are largely, you know, having to displace some behavior in order to bring a new behavior in, and we're in a situation where there are 3 or 4 dominant players: Facebook, Google, Apple, Amazon, you know, that are beginning to suck a lot of the oxygen out of the room. And you begin to see this with, as an example, we were an investor in a company called Zynga, which was a game company that basically was built on the back of Facebook. But once Facebook recognized the value of, you know, recruiting users to Zynga, they began to extract that value by charging 30% for all the transactions and forcing the transactions to go through Facebook. And so you have dominant players beginning to extract the economics out of the market at the same time that consumers are becoming sated. So we don't see that going on forever. And so we're trying to figure out, well, will those players remain dominant? Will they continue to consolidate and basically control more of the consumer's interactions? And what's the mechanism that might undo that? So in order for us to sort of think about how that would happen, we looked back at our experience in the late 90s. In the late 90s, you know, the question that everybody asked when they made an early stage venture capital investment is, well, is Microsoft going to come into this space, right? And what happened in the mid to late 90s is that in the mid 90s you had a very vibrant PC software industry with thousands of players. In the late 90s, Microsoft had essentially sucked that entire industry into the Microsoft Office suite and the operating system. And so Facebook is doing somewhat the same thing today. And we're saying, okay, so what undid Microsoft and what might undo Facebook? So the thing that undid Microsoft was a shift in venue from the desktop to the web, and a shift in business model from packaged software to open source. And so the reason Microsoft couldn't react to the web is that most of the functionality, software functionality, moved to the server side and was delivered in something called open source, which means that the software was freely available. It could be manipulated by everybody. It wasn't controlled by a single vendor. And Microsoft couldn't react to that because they could not open source their proprietary operating system. So the thing that Facebook could not react to is something like open data. So Microsoft was undone when the code became open. Facebook will be undone when the data becomes open. And the mechanism by which the data will become open is something that is talked about as Bitcoin, but is actually the underlying technology underneath Bitcoin is something called the blockchain. And the blockchain is a open public database. It's a general ledger that exists on multiple servers out there in the world. Anybody can store data on those servers, and anybody can see the data that's stored on those servers. So instead of a world where all the data resides on Facebook servers, the blockchain hints at a world where the data resides on the blockchain and multiple services interact with that data. So this is very, very early. And it sort of feels a little bit like 1994 in the internet space, when we're just beginning to see a hint of the commercial internet. What we're doing there is we're making a number of sort of picks and shovels investments in companies that are exploiting the blockchain and putting some tools in place, because it's way too early for large-scale commercial implementations on top of the blockchain. But we think that that's an area that that could potentially open up the market again and create an opportunity. So I'm going to stop there and hope that we'll come back and talk about this question of boom or bubble in the context of yes, there is an enormous amount of opportunity for disruption that continues, but no, I think the valuations that we're currently seeing are not defensible. And we'll talk about in the context of how the blockchain is going to undo that and how open data is going to undo that.
So Chris, one quick follow-on question. We're going to pick on Uber for a second. There seems to be, I think who doesn't use Uber here? Okay. So this has been a pretty insinuated business. It's penetrated like crazy. Is there a way to eventually disrupt it, or what is it about the Uber's engagement in that network that threatens its longer-term role in it? Is
right.
that a better way of saying it?
Yeah. So Uber is a really interesting example. Most recent private valuation was $50 billion. The basic assumption that people who invest at that price are making is that the network effect that Uber has, the fact that it knows where all the passengers are and all the drivers are, is so strong that they'll be able to bring in a whole slew of other businesses, like a delivery business, for instance, and layer it on top, and they'll be able to do it in every market in the world. There are huge advantages to their scale. When I go from San Francisco to New York, I can use the same app. I open up the same app. It's the same user experience, and that's a huge advantage. But the weakness, the ultimate weakness of Uber is that they've actually had to. The valuation is going to create a situation where they have to extract so much value out of that network, and it only comes from one of two places: the passenger or the driver. And today, you've already seen most recently, I think in the black car world, Uber's up the take rate from 20% to 30%. And so, why do they do that? Well, they have to get a return on a $50 billion valuation, so that money has to come from somewhere. So the question is, is the network effect so powerful that they can begin to extract economics from the drivers and the passengers, or will they create an opening for somebody to come in underneath? And if you look at Facebook groups or there's a small little outfit called Sherpa Share, which creates conversations amongst drivers. You're beginning to see real concern, real dissatisfaction among the drivers who feel as if they're being exploited. And Sherpa Share is doing things like actually delivering models to them that show that when you take the depreciation on the car and the cost of gas, they're actually making minimum wage. And so you begin to see information getting out to the drivers that will ultimately create dissatisfaction. And then the question is, can they find liquidity? Can they find passengers on other platforms? And will there be open platforms that begin to undo that market power? And that's the question.
Thank you very much. So, Devin, a little later stage in focus, but software eats the world. So, tell us how you play.
Just hitting Uber for 1 second.
Yeah, okay.
I think 2 weeks ago, they sent an email to everyone who's an Uber user and told you how many rides you'd taken and how many cities. And mine was 480 rides in 19 cities. And my wife was 100 rides. And some subset I was probably my kids. I think that the one thing I would just say on Uber, I agree with Brad's points, except that there's also and we're not investors in Uber, nor are we investors in any of their competitors. I don't have a particular point of view. But when you talk to a lot of the drivers, what they'll tell you is that many of them, particularly UberX, which is where all the growth is coming from, is not coming from black cars. Were not drivers before. A lot of them are students. A lot of them are doing something else. And they're creating an alternative with huge flexibility to earn not a full-time living, but a partial living. So they're tapping a large number of people for who this is actually a very attractive way to earn a living. So I actually think that on the supply side of the driver side, I think that I don't really see a significant issue. Now, on the black car side, which is a very small part of the business today, that's more of an issue because you're basically your alternative was driving a cab, your alternative was driving another car service. But what they'll also all tell you is that the old model, which we've all used, dispatch, is that people had, they would pay off the dispatch guy to make sure they got all the long rides, right? That's not the way Uber works. If I'm the closest to Brad, it doesn't matter whether I started yesterday or I started 2 years ago. So there's a lot of advantages for the driver from an Uber kind of model. And the interesting fact that I got was that, so I think the biggest risk for their valuation is that in order to justify the valuation, I don't think it's so much delivery, though I think that's clearly something they're focused on. It's India and China. And those are not easy countries to crack from a regulatory standpoint. They've got some incumbents who have 90% market share in those markets today. And so the question is, will they be able to successfully penetrate those markets? If they can, look, I'm probably of the view that I think Uber's going to be worth more than $50 billion when it's all said and done. So,
We'll come back in Q&A and talk about that.
So, Brad's smarter than me, so I just walk around and do late stage rounds of his deals, and it works out great. Let me give just a 1 minute background on Insight, because this I think is relevant to the topic. So we're, unlike Brad, we're pretty much a growth stage fund, but all the way to buyout. So we'll do anything from buying a minority interest in a business to buying 100% control of a company. That being said, it's only in software and internet businesses, so that's all we've done. This is actually our 20th anniversary. So we're in the midst of closing our 9th fund right now. And we really have three core pillars to our strategy. One is focus, so we're investing only in software and internet companies. But once we've kind of put that constraint on it, we don't really put any other constraints. So that we can buy as little or as much of a company, we can buy it anywhere in the world, we can buy common stock, we can buy preferred stock. We don't want to force fit a structure on a company. We want to find the right structure for a company. The second is the way we source most of our deals, which is that we have 20 people full-time who cold call companies globally. And that's now 62% of our deals are sourced that way. Why is that important? It's important because it tends to also drive a lot of market intelligence. We talk to 25,000 companies a year to make about 20 to 25 investments a year. And I'm not one of them. I barely speak English, but we have people who speak Mandarin, Spanish, German, Portuguese, and we call into all these countries in their native tongue. Even though most of these entrepreneurs speak English, it's always great to have a first call in their native language. And the third is we have something, and this is I think important as we get to how do you create an edge in a market where things certainly are whether you want to say they're a bubble or not, they're certainly not cheap. Is a group that we call Insight Onsite, which is, think of it as a captive McKinsey within Insight that just works for our portfolio companies. So I think you hear about all the large private equity firms talking about how they need to have something to differentiate themselves to drive returns. I think that's true in our category as well. And so we have a team of people. We have sales specialists, marketing specialists, product specialists, all work for us full time and help drive best practices across the portfolio. Particularly when you're paying some of the prices that we are paying today, it becomes more and more important to actually be able to help improve the performance of the businesses that we're investing in. So that's a little bit of context on who Insight is. So I think we have to, when you're thinking about, are we in a bubble? And I guess if I really knew the answer to that, I wouldn't be coming up to Greenwich at 6:45 in the morning. I'd be in a Caribbean island somewhere running a $14 billion hedge fund. I think you have to start with what do the underlying macros look like, and how do the underlying macros compare to the last time that we had a bubble. We only really invest in two categories, software and internet. Start with software. And I don't know the statistics from '99, but I know that in the last 5 years, just the global software industry has grown 80%. So if you do an SIC code search, what you'll find is there's no other industry that's grown 80%. There's only one, actually. It's oil. And the entire growth in that industry in that 5-year period came from unit price, very little from volume. And in the case of software, unit price actually declined. So you had a huge increase with average unit price going down because business models are changing where price of software is actually coming down. And at the same time, while the industry grew 80%, you had an increase in fragmentation. So the top 10 companies in the software industry actually lost market share. And companies 11 through 100 picked up share. And the most of the share increase actually came with companies that are smaller than 100 and up. And that's created, why? Because there's a lot of innovation in the space. But the interesting thing is, if you go back and look at the stats, even with the top 10 losing market share, every single company grew over that period of time. Because the tailwinds are so strong that even with significant share shifts, you still saw growth in all of the underlying companies in the index. And on the internet, Peter spoke about a couple of the stats, but you've just seen just an unbelievable amount of growth. So whether it's smartphone penetration, which he talked about, e-commerce has gone from $12 billion to $300 billion over that kind of period of time. While smartphone penetration has gone from 0 to 3 billion, you have markets where there was zero cell phone penetration. Even in the U.S. in '99, there was very, very, very low penetration. But internationally, the last 3 years, smartphone penetration has gone through the roof. And you're actually seeing places like India, China, Korea, which are ahead of us, frankly, in mobile innovation. So the underlying statistics, the driving growth, have been incredibly strong over the last 5 years. And the second thing that we see is this internationalization. So we've always invested globally. Actually, from our first fund, we've had investments internationally. Today, we're about 35% international. But the challenge historically was you'd find companies, you'd have a hard time finding talent. You'd have a hard time finding the quality of entrepreneurs that we generally found here. And today, that's not true at all. It doesn't really matter what part of the world that we go to. The underlying quality of entrepreneurial talent is staggeringly high. And we've done deals in just last 6 months, Spain, Germany, Asia, and everywhere we go, there's generally a city. In Germany, it's Berlin. In Spain, there's a lot of interesting things going on in Barcelona. There's like mini tech centers almost everywhere in the world. And what you're also starting to see in places like India and China, and by the way, if we want to have a conversation about a bubble, the U.S. looks cheap in tech relative to India, as an example right now, is where 10 years ago, most of the companies that you saw in these places were basically just copying some sort of U.S. strategy, and there wasn't any fundamentally differentiated IP being created. That's really changing now as well. And you can go to these places and find things that are creating not just copies of a U.S. business model, though all of those exist, and obviously can get to scale, and we've invested in many of them. But now you're starting to see real IP get created in those markets as well. So those are just some of the high-level macros. The other thing that's happened is, and Peter called it software is eating the world. I have a slightly different phrase I use, which is that software is running the world. And recently, David Cote, the CEO of Honeywell, asked me to speak at his technology symposium. And I asked him, well, I don't really know anything about avionics or control systems. I'm not really sure what it is I'm going to talk about. And he said, no, I want you to talk because we employ 11,500 software developers. Now, if I called up the equity research analysts who cover Honeywell and asked them, how many software developers do they employ? Nobody's going to guess 11,500. 11,500 software developers. I don't have a single company in my portfolio that employs 11,500 software developers. And what you're seeing is that number of GE is similar, if not larger scale. So you go across almost every industrial category, what you're seeing is massive investments in software and technology, both because of increased productivity, but also because it's the business model of the future in a lot of these cases. So, I think that you have two things. You've got a macro industry growth that's very, very strong. And then that macro industry growth is not just being driven by traditional verticals that are tech verticals, but it's being driven by verticals that are manufacturing, oil and gas. And in our portfolio are examples of companies that are serving all these industries in kind of new and innovative ways. So does that necessarily mean that just because of all these great stats, valuations are justified? The answer, of course, is no. But what we are seeing, and this is what's really hard to value, is we are seeing companies with kind of unprecedented growth rates. And I mean, Uber's a great example. We didn't invest. And we didn't invest because we looked at it and said, there's no way, this was at $3 billion, there's no way that valuation is justified based on their current revenue. And there's no way what they're modeling is possible because we've never seen a company be able to grow that fast. There'll have to be a speed bump, that, no pun intended, that stops that from happening. And the reality is they've vastly exceeded the numbers that they gave us. So how do you value these types of businesses? The answer is it's hard. And the challenge I see is that I actually think there are companies, and I think Uber is probably one of them, whose valuations, while extraordinarily high, are justified based on their growth. The problem that we see is that rising tide lifts all boats. And companies come in and say, well, Uber raised at, or Zenefits raised at, and therefore I should raise at. And I'm like, well, you're growing 40%, not 400%. And so it's not a relevant comp. The other thing people look at is public comps and say, well, you can't justify these valuations based on the public comps. Well, there's very, very few public companies today that are growing at those rates. There's a very fundamental concept called PEG. And so looking at a growth rate, looking at a PE multiple without looking at growth rate is kind of a flawed analysis. And where we've found the biggest opportunity, so what I'll end on, is the composition of our portfolio, which is if you look at our seventh, so we're closing our ninth fund now. If you look at our penultimate fund, our seventh fund, it was 2/3 of the fund was in growth equity investments, and 1/3 of the fund was in buyouts or control transactions. And if you look at Fund 8, it's flipped. 2/3 was in buyouts, and 1/3 was in growth equity investments. Why? Because we found better relative value in control transactions than in growth equity deals, particularly those that were centered around Silicon Valley, where valuations tend to be much higher. And the interesting thing, having just gone through a fundraise, is the most common question we got was, well, you're paying 15 times EBITDA for a buyout. That nobody pays 15 times EBITDA for a buyout. And I'm like, well, if you give me a choice of owning GDP plus 3%, which is what's in the rest of your buyout portfolio, at 11 times with 8x leverage, or paying 15 times EBITDA for 25% growth, 5x leverage, I'll keep my portfolio, thank you. And so we're able to buy kind of growth tech assets at multiples of EBITDA. And so when you see that, you say, well, that's probably a better relative place to put our money today than in some of the minority growth deals. So that, from our standpoint, from a portfolio allocation standpoint, what we're trying to do is we know we're going to pay full price on growth equity, so we're trying to pick our spots, try to find the ones where we think the growth rates justify the price to the best of our ability, and we won't always be right, and put what we've done, at least for now, is put the rest of our assets into companies that we can value kind of on more traditional metrics.
So one last question. I got to challenge you on that. Maybe it's because you're not in the valley day in and day out, but fear of missing out. There is human emotion that sets in here, despite all that great intelligence about how to do this in a disciplined manner.
Okay, well, so we looked at
FOMO.
and we looked at and passed on Uber. We looked at and passed on Xiaomi. We looked at and passed on
But-
Alibaba
so
an
let's think
earlier
more
round.
generally. What is the implication of FOMO?
Yeah, I mean,
Broadly
it's
speaking.
one of the reasons that I'm happy in New York. I mean, just to be totally honest, as you know, we're the largest fund, and we're also the largest fund that's in New York, right? So when I tell people I work in venture capital, and they say, "Oh, we're in Silicon Valley," I'm like, "No," because I think that I don't get that pressure as much. I'm not running into a bunch of VCs everywhere I go. When I go to my kid's soccer game, nobody's in technology. I hope that's different for the next generation, but it's true today. And so I'm not running into people who are telling me about the deal they just did. Now, every time I go out to the West Coast, I feel that, right? Because there's a tremendous amount of, oh, you just invested in Uber, should I be looking at Lyft? Or somebody invested in this, should I be looking at that? I think it's been one of the reasons why it wasn't planned, but it's been one of the reasons why it's been good to not be in the middle of Silicon Valley.
We could spend a lot of time in that discussion alone because Silicon Valley does dominate this market for
Absolutely.
for lots of good reasons. And Billy, you were just there, so I know you want to comment on that to some degree. So why don't you kick off?
We're going to do blockchain for hedge funds. Good morning. It's great to be here. Thank you for having me. I'm very flattered. My name is Bill Martin. My firm is Raging Capital. We're based in Princeton, New Jersey. Hopefully, I'm going to kind of bridge the two worlds today. I started out as an entrepreneur. I actually started my first company when I was 19, dropped out of the University of Virginia, and raised money from CMGI, which was a hot internet incubator back in the first, was that 1.0 bubble or 2.0? And did the dot-com thing, which packed a lot of experience both on the up and the down for me as a young man. Very formative. And I've been involved with a number of additional entrepreneurial efforts, notably InsiderScore.com, which is an institutional analytics platform used by about 400 hedge funds and mutual funds. I was on the board of Bankrate for about 10 years, which was first a turnaround and then a growth story. So I've had a lot of those experiences, but my true love and passion from a young age was the public markets. Bought my first stock when I was 10, and all roads led to me starting an investment fund, which I did in 2006. Raging Capital. And today we manage about $650 million of capital. We've got a great base of investors, a lot of long-term locked-up capital, which enables us to be primarily public-focused, but we do have the flexibility to do privates, which we regularly do. And really on the long side, we try to be entrepreneurial. We try to be long-term and concentrated. From time to time, we'll be activists. And then we also spend time shorting a lot of these newly public frothy valuations. But we spend a lot of time on the short side. We run a very diverse short book, and over time we've added a lot of alpha and absolute returns on the short side. So kind of both sides of the world. And I view for us a key part of our edge is I think that entrepreneurial creativity and experience. Being able to leverage that in the public markets, which I think is unique. And then also just the 6 degrees of separation that the network enables us. And so being out in Silicon Valley and connecting with entrepreneurs on the ground and kind of seeing both worlds. I was actually just out in Palo Alto a couple of weeks ago, had a lot of great meetings. It is like pure heroin out there. I come back. I brought one of my analysts out there for the first time, and you go into meetings and you like rush out thinking like this huge thing's going to happen. I need to short this because it's all going to happen. And they're right. It just usually takes 8 to 10 years. Docker's going to put VMware out of business eventually, but
We hope so.
but it's always interesting. And I was at a dinner with about 15 or 16 founders. Just a great networking dinner, and the fund has investments in 2 of the companies that were there. And I was asked to describe what Raging Capital does, and I said, well, you guys are kind of startups down here. You're hoping to get up here to go public. A few of you, or a handful of you, or even less than a handful, will become the next Facebook maybe. And we're hoping to obviously buy you at some point here. But a lot of you are going to be pretenders. You're going to go up in here, and we're going to ideally short you. And then, even more of you are going to kind of come out and crash and burn. And in 2 or 3 years.
Should avoid you.
No, actually, Raging Capital will pop up with a 13D, and we might fire you, replace your board, and force you to sell the company. But that's a little bit about what we do. In terms of each of those categories, quickly, and I'll just give you a couple. Things that we're actually invested in name-wise, but then I'll give you just a couple kind of macro thoughts on the market today. But in terms of looking for the next Facebook, notably we were private investors in both Facebook and LinkedIn early on. We've spent a lot of time in recent years in 2 areas. We really think the NoSQL kind of big data analytics area is really interesting. We looked at a lot of companies. We ended up investing in one, a company called MarkLogic, which we thought had just great technology and great backers. We're fortunate to invest at sub 200 million, and they just closed around at over $1 billion. Not sure that's right, but that's one area, and we continue to have that investment. And then we've spent a lot of time in cybersecurity, which is, I think, valuations are crazy, but it's still a problem that hasn't crested. It continues to escalate. We've made one investment there in a company called Shape Security, which I think is a really good example of us leveraging the network. Shape was started by a friend of mine who I met way back in 1999 when I was a speaker at MIT. He was an entrepreneur and a student at MIT, and I met him. He ended up going to Google early, and then he went to the Pentagon and headed up cybersecurity for Obama. And he, in 2011, started Shape and subsequently raised money from Kleiner and Venrock and Norwest and Google and Who's Who. And we got a call last year that said, we're looking for a trusted party or two to come on the cap table and provide a little bit of insider liquidity. We'd love to have you. And we were very pleased to make that investment. And I think one of the really interesting things about their business, and I think it's also true of Palo Alto and FireEye in the public markets, is being connected to the cloud, they see in real time the transactions and the attacks, and they have the ability to develop new products and innovate much quicker than new startups who don't see the flow of data that they do. And so I think that's a real competitive advantage for the guys who have scale in those markets. So anyway, I'll move on. In terms of shorting the pretenders, a quick example of an area where there's been a tremendous amount of venture capital around Hadoop, which is an open source database-driven technology used a lot around big data analytics and enabling that market, spun out of Yahoo. That's an example of too much venture capital. There's a tremendous amount of capital has gone into 3 big players. Hortonworks was the first company to go public. As we like to joke internally, it trades at 13 times their burn rate. So they're going to lose about 150 million this year, and you can kind of do the math. We think they're like Red Hat before them. They're trying to build a business model around open source software. We think there's all sorts of issues. One, we think it's a much more narrow market than an operating system, so we think the idea of building a business model around that open source is going to be much harder. We think the use cases for the customers, they're there, but they're not super urgent, so we think there's going to be a little bit of a timing issue in terms of the ramp. And then finally, they get 3 big guys with tons of capital just attacking this market. So it's going to be very hard to build a business and justify the valuations there. So that's an example of a name we're short. And then finally, just talking about longs. They were talking about early stage deals, 50 million, 100 million, throw it all around. It's the World's Fair. We love looking for neat technology that's beaten down and out of favor, and I think the public markets give you the opportunity to find these things on the cheap because everyone hates them. A good example of that, we were investors in a company called Vitesse Semiconductor, where amazing technology, semiconductors that go into telco carrier equipment and increasingly Internet of Things. Had some accounting and balance sheet issues. Also had a board of directors that owned all of 6,000 shares of stock. Not the type of investment you want to be passively involved. Raging went in. We ended up becoming the largest stockholder, the largest bondholder, as well as putting 4 new directors, including myself, on the board. And over a 3-year period, worked to fix the balance sheet. We led a recapitalization of the balance sheet. We obviously fixed the board and worked to turn around and grow the business. And we had a nice exit earlier this year, selling the company to Microsemi. And so that's an example where we got really hands-on, but there was a tremendous amount of invested capital and intellectual property there that was incredibly valuable. a current example, we own just under 20% of a public company called Intermolecular, which went public in 2012. Trying to think of the VCs. U.S. Venture Partners, Erwin Fetterman's actually still on the board there. They went public at $10. Today's stock trades at $2, which is about a $50 or $60 million enterprise value. We think the technology is out of this world fantastic. It's combinatorial technology for the semiconductor and some of the solar industries. They were 14th on the patent power list. They have over 1,400 patents. They have customers like SanDisk, Toshiba, Micron, First Solar. And they have almost 200 engineers, of which a majority of which are PhDs. And we're buying, basically the enterprise value of this business is about $60 million. They just brought in a management team that used to run Tessera, which was a very successful IP licensing company. And so basically for the price of a 7-person startup, we're buying 1,400 patents and an amazing customer list. They've had issues, no doubt, living up to expectations, but that's the type of investment that we love, kind of going against the tide. To kind of two points I wanted to make more broadly. First, I wanted to kind of share a macro viewpoint on just the market kind of anecdotes. And I think to kind of best do this, I'm going to actually go back to 2000. And I remember this was one of those light bulb moments. But the chairman of my board at Raging Bull, which was my first company, Raging Bull, thus the Raging Capital name years later. But we ended up raising, I dropped out of college. We ended up raising over $20 million of venture capital from CMGI and CNET. Did the dot-com thing. I was drinking the Kool-Aid. I was in 2000. I was 21 years old, and I was living it. The chairman of our board was Dave Weatherall from CMGI, who was used to work with Fred Wilson, but true visionary, very early on, and fascinating guy. But from 98 to 2000, the value of CMGI went from like 400 million to 50 billion. And Dave Weatherall was a very wealthy man come March of 2000. And I remember being actually at his house having dinner in March of 2000. And that day, an investment bank had put out a report saying that on a sum of the parts, CMGI was worth 65 billion. And this really upset him to no end. I mean, the whole dinner, he was very upset because the market was valuing at 50 and it was really worth 65. And of course, this company was worth 400 just 2 years earlier. And I just remember the light bulb going off, even at 21 years old, just saying, something's a little off here in the world. And fast forward to a couple weeks ago, it's not a perfect comparable. I'm not calling a market top or what have you, but I had a meeting. We were at a preeminent private equity firm in the Valley, and literally the first 30 minutes of this meeting was a mix of sort of teenage giddiness about all the money they were making. We invested in this at $1 billion a year ago. Now it's worth $5 billion. And we invested in this Series A at 100, and 9 months later they just did a round for $600 million. I mean, these are real numbers. A little bit of that combined with fundamental disbelief, where they just, you ask them, well, what's the business model, or how do they justify it? And they kind of just shrugged their shoulders, like they themselves couldn't explain it, and the little light bulb kind of goes off. There's a lot of amazing things going on in the world of technology. There are certainly opportunities, but I think you have to be very selective, and I think it's a time to sit on your hands. Unfortunately, you can't run a long-short strategy in the private markets, but certainly in the public markets, we're excited about the opportunity to be capitalizing on kind of dispersion between quality in the market. So that's thought number one. Thought number two, trying to, I think, maybe bring this home to some of the opportunities you're seeing in terms of investments. But, I think like a lot of asset classes, real estate, stocks, bonds, you name them, thank you, Federal Reserve, there's just too much money out there. And certainly a combination of that fact plus chasing the next Facebook, huge amount of dollars flooding into the Valley, a lot of them from untraditional investors, looking for those opportunities. And, when you talk to those folks, a lot of them justify the valuations they're paying by saying, well, we're buying preferreds. And so, yeah, we paid $10 billion valuation, but we're preferred. So it's asymmetric. We're not going to lose any money. Maybe we can make a lot of money. I think that's very flawed thinking. I think it's a very high-risk strategy for a couple of reasons. One, unlike the preferreds of just a few years ago, Generally, the preferreds today do not carry a coupon. You used to get paid 6 to 8% just for waiting around, so at least you earn some return on your money while you're waiting. Today, it's generally a zero interest rate, and that's number one. Number two, there's generally not a path to liquidity in that, in the past, oftentimes you would see a put at year 5 or some type of path to liquidity to get out of your preferred. Today, they're generally in perpetuity, and you're kind of in. And so what I think investors are missing is the time value of money associated with those preferred investments, the path to liquidity associated with those investments, and the risk associated with that liquidity. And number 3, the real risk of cram downs. It's all well and good when things are looking great and you've got these great projections, but if the business plan takes a little bit longer, they need another raise or two, Silicon Valley is a capricious place, would not be surprised to see a cram down, and your preferred is maybe a little less preferred than it once was. And so I think we see it in the public markets when we look at balance sheets all the time that have preferreds, and a lot of times those preferreds are worth 10 or 20 or 30 cents on the dollar. And that's what I have to say today. And
So just carrying on that, as our public market expert here,
I'm not sure the expert.
We're seeing, as we look at the IPOs over the last couple of years, completely dominated by the biotech space. What is it about technology companies that is preventing them from going public and instead attracting crossover investments into private capital structures, if you will, that we agree with you appear to be unstable at best?
Well, I mean, don't get me started on biotech. Biotech, there's amazing things going on in biotech, obviously, but it's actually an area where we've spent an incredible amount of time shorting stocks, which has not been a lot of fun. Whatever little hair I had is even less. What we're seeing actually in biotech, I mean, we're in year 4 of an incredible parabolic bull run in biotech. Is we're seeing a lot of bad guys, we're seeing a lot of promoters, we're seeing a lot of frauds. And so we actually have a portfolio today of probably 25 to 30 names. It's approximately 900 to 1,000 basis points of capital. So, we're sizing these as kind of 30 basis point type positions, knowing that 1 or 2 might really work. But the vast majority of the names in our book, they're bad guys. They're guys that have no business. They have track records of being involved with pump and dumps historically, et cetera. So we're seeing a lot of that in biotech.
So why aren't the IT companies going public instead of taking this late round stuff? What is it about the public markets that are causing that not to happen?
I don't have a good answer for that. I mean, I think there are a lot of companies going public on the IT and technology side as well, but maybe one of these guys has a thought.
Yeah, I think you're implicit in your question is that all these companies want to go public. And I think that what the late stage market has allowed companies to do is to stay private longer.
Yeah.
And in many cases, that's the right decision. I mean, the other thing, I mean, there's a bunch of topics. I mean, hard to cover everything in 8 minutes, but the public markets have changed pretty dramatically. So it used to be 10 years ago, if I was doing a pricing call on one of our companies that's going public, I recognized 7 or 10 of the top 10 buyers. Right now, if I recognize 2 to 3 out of the top 10 buyers, that's a pretty good call. And the short-term orientation has changed dramatically as well. And so there's less of a desire on the part of public, a lot of CEOs to go public. They want to wait as long as possible. Right? So that's on the company, call it the issuer side. On the private side, you have something that is a fundamental thing that's changed. Is if you look at Microsoft, 95% of all the gains that Microsoft stock has achieved since going public, or since inception, were shared by public investors. Okay. In Facebook, it's 40%. Twitter so far, 0. And so there's an interesting statistic somebody calculated. In order for Facebook to, I think it was Andreessen maybe. In order for Facebook to drive the same public returns that Microsoft did, it would have to have a $35 trillion market cap, and that's probably not going to happen. And so So what does that really mean? What it means is that public investors, and why are you seeing the T. Rowe's and the Putnams and the Black? I mean, I've talked to all these guys about this topic, and their view is, look, one, I can't get a 10% position in an IPO anymore, right? So if I want to have a meaningful position in a company, I'm best to do it as a private investment. And BlackRock took a big position in Alibaba, and I was talking to the guy because he kind of paid an above market, even private price. And he said, yeah, but I'm going to hold this for 10 years. And this is the only way I could get a scale position. I was willing to pay a premium to get a scale position. I don't want to – yes, I could get $20 million at a lesser price, but to buy a $200 million position, this is the price I needed to pay. And so on both sides, you've got issuers who are saying, I want to stay private longer. And you've got private investors who are willing to help that happen by buying positions. Now, then there's another set of companies. So that's the bigger guys, right? That's the Ubers of the world, the companies of that scale. The companies that got what used to be in the the 80s and 90s, as a tech company, you could go public with a $200-300 million market cap. That's a conversation worth having. That's almost impossible to do today. It's so easy with that type of market cap to get lost because market cap have gone up so much that for a public mutual fund, a $300 million market cap doesn't move the needle. And so if you're the $40 million revenue company, if you go back to the days of Robbie Stevens and Hambrecht and Quist, the $40-50 million revenue company was kind of the bread and butter software kind of IPO. That market's kind of gone right now. And so that's a more challenging part of the capital markets. But the later stage deals, what you read about in the front page of the journal, that's not, they can't go public. That's a kind of a bilateral agreement between issuer and buyer that this is a better alternative.
So that means to invest in a venture fund means you probably should expect to be in an evergreen fund.
No, because if you look at a lot of these rounds, why I don't really worry about your point with respect to preferred stock. I mean, any one of my really late stage companies, it's a liquid market. I mean, I can sell my stock. I can sell my stock as a private. Uber investors have had liquidity. Alibaba investors have had liquidity. No, I'm not saying they should, but they can.
They do.
And I think you have.
Let's open it up.
Yeah.
Thank you. We have to start with you after all. We haven't seen you for a while.
Actually, I know my fellow Middletown Cardinal, but last time I saw it was a tech store, so I was down at his Enway Stern. Parenthetically, a friend of mine, Brian Cullen, happened to be involved with that competition. They won the first prize of $50,000 with an entity called Tote, and that entity, 3 years later, through his auspices and whatnot, is called Pinterest. What role do you gentlemen think is the accelerator, incubator model as you look around in the industry? Is that just flawed, or is that something worth monitoring? Where do you get these ideas in terms of, are they legitimate? Because of the breadth of these kinds of models, incubators, accelerators, things like that.
So that's actually really interesting to think about because, and also thinking about in the context of bubble or not, because the CMGIs of the world, the last set of incubators that we had in the late 90s, I think were actually probably fundamentally not good for companies. They kind of created an adverse selection where, people who didn't know how to hire a lawyer or find a lease ended up, being sort of coddled in those incubators. And then when the markets turned the other way, they didn't have the strength to stay around. And so I don't think they did a good job. And Bill probably has another perspective on that. Today, Y Combinator, which is the West Coast accelerator that produced Airbnb and I think Uber and a bunch of other very successful companies, has been a real phenomenon. So they're not really providing the same set of services. They provide a boot camp to get to product market fit, and they don't provide real estate and lawyers and the other kind of sort of administrative services. And then they create these very powerful networks. I mean, one of the interesting things that Y Combinator companies do is that they end up selling to each other. So and that creates some scale as these companies scale all by itself. So I think it's something that you have to pay attention to. It is. I'm frankly surprised because my bad experience in the 90s led me to kind of stay away from them, but I'm surprised to see them making as much of a contribution as they are. One of the questions that it begs is, are we headed to a world where we're going to have a larger number of smaller companies? And in some of the internet services spaces, I think that's the case. And the question is, what creates scale, and and will these incubators and will the fact of how relatively inexpensive it is to create a company lead to a world where we have a lot of smaller companies, many of which aren't going to go public? It's going to create a whole set of interesting problems about how do you invest in them.
No, I agree. I mean, I think in the case of look, to me, it's no different than in venture in some ways, right? If you're a really early stage, and you've got a great network business, you're going to go see Brad. And if you've got a later stage business, you might go see Sequoia. And if hopefully you'll go see us. And Y Combinator has created that brand that if you're a really early stage kind of great entrepreneur, you go there. So quality goes there. And now that being said, that there's probably 200 incubators and accelerators across the country. The vast majority of them don't have a quality that looks anything like Y Combinator.
3,000 globally.
Okay, there you go. My guess is that 2,900 of them don't really accomplish anything close to what Y Combinator did. To me, it's no different than venture in some ways.
Y Combinator is raising a late-stage fund for its businesses right now.
My
God.
By the way, I heard $5 billion.
I don't want to talk about
$5 billion?
Yeah. We had a question over here.
Really?
So another characteristic of these late-stage privates has been just the huge volume of capital they're raising to postpone their need to go public. And I wonder if you guys could comment on that aspect of, they have big valuations, but for instance, Uber is sitting on rumored $4 billion of cash, and so it doesn't need to rush to the public market and justify its valuations to investors at that point, and it can gobble up things that may be competitive that it hasn't figured out on its own. So how do you look at the bubble in light of what might be different this time? It's never different, but all this money these companies have been able to raise to sort of see themselves through some of the storms.
Go ahead.
If you don't need the capital and there's a liquid secondary market where insiders can access capital, being public is a big distraction. You got to deal with guys like me. Public markets are particularly not good for long-term time horizon investing. So it's not surprising folks, particularly the more successful guys, are choosing to stay private longer. So I think it's a natural phenomenon. I think also the Jobs Act probably simplified that as well in terms of opening up the cap tables and making that a bit easier.
If I were an entrepreneur, I'd execute. If I were an entrepreneur, I'd execute the same strategy. I mean, the reality is a lot of companies go public too quickly, and they get a very high valuation, and a large percentage of them end up in the short portfolio because they're not ready. And so if I had the ability to raise capital at rates that are, by the way, probably more attractive than the public markets, right? Valuations that are more attractive than the public markets, and be able to execute on my strategy, I would. I'll give you two bubble trades that there's no way for me to execute on, but I'd probably execute on, right? Which is that if you add up all the unicorns, they add up to the valuation of Facebook. If you add up every unicorn that's been raised, if you said me, do I rather own Facebook at $350 billion market-weighted unicorn index, I'd take that, right? Because there's going to be another Facebook in there, but I'm not sure which one. The second one is I talked about India being the most overvalued internet market right now. I believe that. But if you add up the market cap of all the privately funded internet companies in India today, it's between 30 and 35 billion. What do I think it'll be in 10 years? I think it'll be 300 billion. But I can't tell you how. Right, so if I could market weight own the entire private company index in India at a $30 billion valuation, I would do that. Figure that out, let me know. And so that What does that say? Does that say that every one of the underlying valuations of those companies are justified? No, it doesn't. But implicitly what it says is that the underlying growth over the next 10 years in the Indian market, just to pick that one example, is going to be very, very large. There's going to be some outsized winners. And so, therefore, some companies' valuations are going to be justified. The hard part is figuring out which ones. Right? That's presumably what we get paid to do, sometimes well, sometimes less well.
Yes, Ryan.
Brad, picks and shovels for the blockchain. I'd love to hear 2 minutes more about the blockchain ecosystem that you're seeing. If you could give us a two-part, please.
I can try. It's so the idea behind the Bitcoin blockchain is that it's a decentralized ledger. And the reason for the currency is actually to create an incentive for people to store the data on the ledger. So when you have anybody, they can be doing it in their basement, they can be doing it in a huge data center in Iceland, runs a set of algorithms to determine whether or not a particular condition is true on the blockchain. It spits out a Bitcoin after some period of time, and so that's the economic incentive to run these algorithms. And so the great thing about that protocol is that it means that there is no central point of control. Everybody is checking everybody else's data, and there is no single point where you have to go and say, do I believe this person or this company or this government? And that's the genius of the protocol. So now you have this shared public ledger where there's a shared truth that anybody can look at. It's one of the misconceptions about Bitcoin is that it's somehow anonymous and private and all sorts of stuff can happen there. It's actually the opposite. Every single transaction that has ever happened ever on Bitcoin is in that ledger, and it's accessible to anybody who wants to see it. And so you have this shared truth. So the reason that we think it's potentially disruptive is potentially enormously disruptive is that we go back and think about what happened with the internet, and the internet fundamentally disrupted the media industry. Prior to the emergence of the internet, the media industry was defined by distribution. You had a cable channel, you had a radio station, you had a newspaper, and the distribution, because of the scale economies associated with distribution, controlled the content. So if you wanted to reach somebody on the radio, you had to go through somebody who owned a radio station. After the internet, anyone could get to anybody. And the reason that happened is the internet, for the first time, introduced a shared public communications layer. Right? So the question we're asking ourselves is what happens if you add on top of that a shared public data layer? Right? And if you think about the way systems are built, there's a communications layer, there's a data layer, there's an application layer. And so we're moving up the stack, and this now shared public data layer means that you can have potentially direct competitors using the same data set and competing fiercely on another dimension, but agreeing to a common data set. And that feels to us to be fundamentally disruptive. The reason we're thinking about it in the context of network effect defensible businesses like a Facebook is that right now, Facebook's defensibility has to do with their proprietary control over the data. And if a new competitor emerges that says, I don't need to have that proprietary control. I'll put the data on the blockchain and allow others to share in that data, and I'll compete at a services layer on top of that. We think that's the possible vector for a complete transformation. So what we're investing in, we've made 3 investments. We 4 really, because we're investors in a company called Coinbase, which handles some basic Bitcoin functionality, handles a wallet, handles transactions in and out of fiat currency from dollars to Bitcoins and back and forth. But we're also investors in a company called OneName. OneName is essentially an identity management system on the blockchain. So today, a lot of people have signed into things using a Facebook ID or a Twitter ID or a Google ID, so you can get into any service on the internet. But whenever you use the Facebook ID to get into a service, you're basically telling Facebook what you're doing, and Facebook is actually collecting data on all of what you're doing on that site, right? And so OneName is a blockchain-based identity management system that's independent of any underlying service. So so we think that's a sort of fundamental piece. We're investors in a company called Mine, which is providing a kind of title attribution, ownership attribution for any digital file. And it records that title in the blockchain. So again, it's a shared truth. It's not controlled by them or by anybody. It's just an agreement that, that Brad owns this picture that's now a set of bits out on the internet. And then the last one is a company called, actually it's called OB1. It's based on a protocol called the Open Bazaar Protocol, which is an open marketplace. So today, and this gets into the sort of boom or bubble question, marketplaces extract a take rate. eBay gets 7% for selling a couch on eBay. And we're seeing marketplaces use that network effect leverage. That you want to sell your couch, you want to go to where the buyers are, to extract higher and higher take rates. And so Open Bazaar is a open marketplace that's defined as a protocol. So instead of having a central server where I list my couch, I just list my couch via this protocol, and anybody who has an app on their phone that runs that protocol can find that couch. And so it takes the middleman out of the marketplace. And that, again, feels fundamentally disruptive to us. And it could, if that open data layer becomes important, you can imagine how some of the pricing for any network effect defensible business is sooner or later going to become hard to sustain.
Thank you.
Yes, sir.
One of the things you guys haven't talked so much about, a little bit, about cybersecurity. I mean, everyone's got hacked. You got more open data now. You've got more accessibility. And there seems to be millions of people trying to hack against all these systems. If you open up your computer, you get hit every single second. Someone's trying to break in. Tell us a little bit what you guys see about security, about all this data being out there, and what it means to people, because it seems to be happening more and more, at least to my colleagues, people around the world. Everyone's getting hacked. Everyone's changing their ID, their email, et cetera. What's going on in this area? I think this is a fascinating area for investors.
Right.
Well, Bill should start because he's more experienced as an investor in cybersecurity.
It's a big problem. It's a big investment opportunity, and at the same time, there's not enough. There's a lot of market cap chasing very few number of names, and so in the public markets, Palo Alto is probably regarded as the leader, and they've executed tremendously well, and they have a product they've organically developed. It hasn't been piecemeal acquisitions, and so they've really scaled that very eloquently and done a fantastic job. Fire, I hear more mixed things, although it seems like they're getting their legs under them. And then from there, there's a lot of guys who play indirectly in security, or their parts are not pure plays per se, and there's a lot of competition, I think, with some of the smaller guys. Public markets want more names. I think that's why you're seeing the valuations in the private space they're insane, and that's capitalism's way of saying, hey, we need a lot more here. My conversations, we have some pretty good contacts there, including a couple of my contacts spent a lot of time at the Pentagon, and it's a real problem. They're of the strong view that we're still in the very early innings, that we're nowhere near the problem kind of cresting. It continues to get worse at an accelerating rate. And from a government perspective, there continues to be a lot of challenges with bureaucracy and really mounting up and realizing the fact that we're fighting it's another front in a war. That's going to be a really interesting evolution over the next decade in terms of how the government responds to that.
I think that story from last week about the records being stolen from OPM, it's underreported. So having filled out a lot of those forms, the amount,
including your social security number. And,
well, that's everywhere I've traveled. You basically tell them everything about you, every relative. It's an immense amount of information, addresses of everybody. social security numbers for other people, and more importantly than that, it was also people who were applying for clearance, right? So that can be people who are working for the CIA as spies. All of that was taken. And so the amount of information that the current view is that it's the Chinese, and that's what's been publicly discussed, and I think that's probably what they also believe. It's just a tremendous amount of data. Now, when you talk to people in the government about the security systems that they have, there's still many of them are, notwithstanding the significant IT budgets that they have, are antiquated. So there's a huge opportunity, and I think it's probably one of the most, I think it's one of the scariest things out there right now. And the amount of data that's sitting behind, firewalls that aren't that secure is tremendous.
So the really fun thing about being an early stage investor is that you can look at things at a slightly more abstract level. These guys actually have to make money making these bets. But
Funny how that is.
I look at this question of data in a slightly different way. Everybody in the last few years has been talking about data as the new oil, as the fuel that fuels the digital economy, and controlling the data is controlling the key asset. What I think we're beginning to understand is that data can also be a liability, and that if you control a big data set, if you're the former CEO of Target, you think data can be a liability because you've lost 80 million records, and all of a sudden, you've created a huge problem for yourself. So, and it's this vulnerability of data and the responsibility for managing that vulnerability or limiting that vulnerability that creates a problem. One of the things that I think we as a society are going to have to grapple with over the next few years is the whole concept of whose data it is and who's responsible to whom for the loss of that data. Today, the conventional wisdom is that if the data's on my servers, it's mine. And the fact that you created it by interacting with my service and that it's a reflection of your personality or a lot of your, private, contributions to our service is not my problem. I think we're going to start to change that view. I think we're going to start to hold companies like Target and companies like Facebook responsible for the data that's stored on their server. And I think ultimately that may become a risk, a business risk for those companies, and that they may need to find ways to manage that risk. If you look at the way startups today handle credit card data, they don't want it on their servers. They use third-party companies that have much better and more robust security systems to store that credit card data, and they just go get a hash of that credit card when they need it, and so they don't want to store that data. There's a long, interesting, idea here about the evolution of how we think about property. We spent 2,000 years defining physical property so we could create markets around it. We've just begun to get into the really messy world of what intellectual property is, and that's where patents and copyrights play, and that's why there are all these lawsuits around that. We have not even begun to talk about what property rights in data mean. So we're a long way from being able to create markets around that data, and I think we have to get there.
Listen, we've overspent our welcome here today. Thank you, everybody, for your patience. Hope you found it interesting. I'm fascinated by it. Thanks to our speakers.
Thank you, Peter.
Thank you.
Bill, it's refreshing. You talked about giddiness. It's refreshing to see the sobriety on this panel. 1998, sitting in your chair was David Wetherill, and he talked about all the funny things, and he couldn't believe his valuation. Another fellow who sat in your seat was Craig Venter, and he just had mapped the fruit fly, the genome of the fruit fly, about to map the human genome. But one thing I'm really disappointed he talked about a cure for male pattern baldness in the next 5 years. It never happened. It never happened. We were robbed.
That was the bubble.
That was the bubble. But housekeeping, July 17th, Connie? 16th. We're going to be back here Most of the people in this room, and perhaps our speakers will appreciate this, we're into buying people and assets, not necessarily securities or instruments, but we're going to try to define skill as it pertains to different kinds of strategies. It's going to be married with our best practice document on terms and conditions and fees in the industry. So with that, our education committee meets tomorrow for the first time. This year, we're going to start writing best practices again. And our co-chairs this year are Mark Silverstein and Bill Jarvis. Once again, we're going to be doing that. And if anyone wants to participate or has any input in that, please see Connie or myself. Again, thank you. Speakers, very good job.